Welcome, everyone. I'm Dr. Nkem, and I'm an emergency medicine physician and a real estate investor. And if that combination seems unusual to you, well, you're not alone. That was my story, and things changed about maybe 5 to 6 years ago. I would have told you that real estate investing was for other people, right? People who had the time, people who grew up around real estate investing, people who understood construction, property management, all those things. But what I discovered changed everything about my financial future. And today, I want to share exactly what I've learned with you in the simplest terms, or as simple as I possibly can. And by the end of this session, this webinar, I want you to be able to understand exactly how multifamily apartment real estate works and why it's one of the most powerful wealth building tools available, and how you can participate in it even as a busy professional. But before we get in, I want to take a moment to address something important. As accomplished professionals, I do understand the value of thorough due diligence, and so do you, in anything that we do. And so the information that I'm sharing with you today is exclusive to the guests and those who are listening. And even though I'm really excited to share it, right? This opportunity and all the other ones, I definitely encourage you to review it with your advisors, your accountants, just anyone who's of importance to you, because that's what sophisticated investors do. And you are that for, joining, for listening. So let's now jump into what really matters, which is what we're talking about today. This presentation, this webinar is really designed for people who are successful in their careers. They have been successful. You've worked hard, you've made good income, you've made even great income, but you're starting to realize that wealth is, and that wealth, that what you're building is entirely dependent on you continuing to work. Whether you're a doctor, a lawyer, executive, a business owner, whatever that looks like, you're maxing out your retirement accounts, right? Maybe you're even dabbling in stocks, but you're thinking, well, there has to be a better way, right? Because all your time is dependent on what you're doing right now. And you want your money to work as hard as you're working right this second. You think, okay, I want passive income. I want income that shows up whether I'm on shift, whether I'm working, whether I'm on vacation, whether I'm sleeping, and eventually while I'm retired, right? If you're thinking along those lines, then I would say that you are in the right place. But first, let me tell you about the golden handcuffs. You've heard about this, we've talked about this, and I felt like maybe I wore it for years, and you might be sitting here listening right now, or the recording, and you're thinking, this actually might be my story as well, right? I was making excellent money in the ER, multiple six figures, and from the outside, everything looked great. But here's what was really happening, right? Every month, I needed that paycheck, or every 2 weeks. But I learned very quickly that my lifestyle to some degree had scaled up with my income, but I had zero ownership. And so everything that came, right, I had no ownership, but all of that income was being produced without me being there. I had the job, I had the wealth generating assets, and then one day something happened. And that's maybe why I'm here today, right? A private equity firm took over our ER, and suddenly that thing that I so relied on, which was job security, it almost evaporated. And that's when I realized I wasn't wealthy. I was just a high paid employee. And there's a very big, massive difference behind it. So this is what I did, right? I was thinking, here I am, I'm a board certified emergency physician, working myself to exhaustion. And then one corporate decision, right? And everything just kind of fell apart. That's when I started looking for alternative sources of income. And that's when I stumbled upon something called real estate syndication. And I'll explain all of that to you. I had never heard of it, but this is what I had that time, right? I had residual income that was just sitting and doing nothing. And so I decided, well, I wanted to do more with that money. I wanted to learn more. This is what I discovered, right? That I can invest in large apartment buildings, those kind of properties that I'd never been able to buy on my own. But alongside with other investors, right, I was able to earn passive income without being a landlord, without fixing toilets, without taking tenant calls at 2 a.m. in the morning. And that's what I did, right? I took that money and I put it into a deal. And within 90 days, I received my first distribution. And that it was a direct deposit. That money showed up while I was working a shift. It was money that I was earning while I was asleep. That's when it really hit me, right? This is how wealthy people build wealth. They own assets, and those assets start producing income. So they're not trading their time for money, they're putting that money to work. And so today, right, I'm sitting here telling you that I still practice medicine, but it's by choice. And I built Phoenix Capital Investment when we manage over 120 million in assets across over 500 units. And I want to show you exactly how this works, because if I can do it while in the ER, then you can absolutely do this too. So today I want to break down 3 secrets that completely changed how I think about wealth building. And they're not complicated, they're actually pretty easy. And you're going to be shocked as to how simple they are. And sometimes people don't want us to know about it, right? Because we think investing is very complicated and it needs to be complex, but I think it's really pretty simple. This is the truth. The fundamentals of wealth building are very straightforward. And I want to explain that to you in kind of what I've learned and how I got here today. And I want to show you real examples. And so by the end, right, I want you to understand exactly how this works and how apartment real estate investing is potentially one of the most powerful wealth building tools that are available to high income earners. And it's because of how passive it is. So this is the first secret, and it's simple. It's almost obvious. It's that wealthy people don't get rich by working more hours. I told you it was simple, and it's a no-brainer. They get wealthy by owning assets, and those assets produce income without direct involvement at all. If you think about it, right, Warren Buffett doesn't clock in at Berkshire Hathaway. Like, he owns businesses, and all those businesses generate profit. And your landlord, if you live in an apartment, right, your landlord doesn't show up to the apartment every single day. That property is generating income automatically. That's the fundamental difference between a high income professional and a truly wealthy person, because that wealthy person relies on ownership. And the question is, well, what should you own? So I want you to compare your options, right? You could invest in stocks, which I think you should, because I do believe in diversification. And those stocks are completely passive. So you have zero control. They are subject to market volatility, right? The average return is anywhere from 7 to 10%. And if you hold long enough, right? But if you see what happened in 2008, 2020 with the pandemic, right? And every correction in between, let's just say your $100,000 investment could become 70,000, and there's nothing that you can do about that. And that can happen overnight. So, or you could also buy single family rental properties, right? You have control, and now you're a landlord, right? So you're getting calls about the leaky faucets and the termites, and you're dealing with evictions, and you're dealing with property management, you're dealing with maintenance. In essence, right, you just found yourself another job, which is what you were trying to avoid in the first place. Or this is what changed everything for me, right? You can invest in apartments. And so you get the benefits of real ownership, right? So you're going to get cash flow, and you get appreciation, and you get tax advantages, but you don't have to be the landlord. You have oversight through, all the regular reporting that you're going to get, but you don't have any of the day-to-day involvement, right? And the targets, right? The target returns that we're going after is typically anywhere from like maybe 12 to 18% annually. And sometimes it can be a lot higher than that, but that's what ownership now starts to look like. So why multifamily? Why apartment real estate specifically, right? Why not office? Why not, retail? Why not any other type of real estate investing? This is why, because multifamily gives you kind of 4 simultaneous wealth building engines. And I want to explain to you in simple terms. The first one is cash flow, right? This is exactly what cash flow is. The property generates rental income every single month. So after paying your expenses and your mortgage, there's profit that's left over, right? That profit gets distributed to investors, and that happens maybe quarterly. And this is the money that shows up in your account, whether you're working, whether you're on vacation, whether you're sleeping, whatever, right? And so that's cash flow. And then you have appreciation. Over time, real estate values, they tend to increase, right? But this is what most people don't understand. In multifamily and apartment real estate, you can actually force that appreciation. So if I buy an apartment building and I increase rent, I can increase rent by renovating the units, by improving the operations. But when I do that, right, I'm increasing the property's value. And so that's not speculation, right? That's a business strategy. And that's something that we use. And another thing is also tax benefits, right? tax benefits is really huge for high income earners. And this is through something called depreciation. So you can receive, cash distributions that are sometimes partially or fully tax sheltered, just depending on if you're a real estate professional. So that kind of differs based on whether you're just a passive investor or, again, you're a real estate professional. But the IRS will let you write off the building's value over time. And so even though the property is actually going up in value, like, you can actually depreciate it. And you can get all of that depreciation year one and something called bonus depreciation. Okay, so I want to make this a little bit more concrete with a very simple example. Let's say you invested $100,000 in a multifamily syndication. This is what typically happens. Year 1 to 5, you're going to be receiving quarterly distributions, and that might total maybe 8,000. Let's just say 8% cash on cash. So this is money that is showing up in your account without you doing anything at all. And then year 5, let's say year 5, we sell the property. The value has increased through what we talked about, through renovation, through improved operations. The loan has been paid down, and then you receive your original $100,000 back, right? Because you get return of your capital. So you get that return of your capital, that's $100,000. Plus, at the end, when you sell, you get profit, right? So let's say you make an additional $60,000 to $80,000 in profit. So all the distributions you have been getting from year 1 to year 5, plus your initial $100,000 plus the profit, right? So you turn that simple $100,000 into anywhere from like $200,000 over the span of 5 years, right? That really looks like a 15 to 18% average annual return. And so that's what that looks like in just a simple example. And this is the kicker, right? Because of depreciation, you can almost get maybe like 60% of those quarterly distributions. They actually could be tax sheltered. So if you are in a high tax bracket, this is huge. So compare this to like leaving that $100,000 in the stock market, or, where you'd maybe average maybe 10%, or leaving it in a savings account. But in any of this, right, you're getting full tax exposure, and then there's like constant anxiety of volatility about what's going on in the market. So that's just an example of how this makes sense, or a way to think about investing in apartments. So this is the first belief shift that I need you to make, right? You've been told that real estate investing is complicated, it's time consuming, it's very risky, that you need to be an expert, right? And that's not the case, right? You're a busy professional. It's true for some types of real estate investing, but it's not true for multifamily syndications. You can own pieces of very large, professionally managed apartments without talking to a tenant, without fixing anything, without dealing with property management. That's really how institutional investors start to think. So think about like pension funds and insurance companies and these high net worth, these families, right? They invest in real estate and they do it through this medium. Now you can, because you get it. It makes sense to you. So that brings me to secret number 2, which is the ownership model, right? When I first learned about the large apartment complexes, I thought, well, this is great, right? But how am I supposed to buy a $33 million, $40 million property? And the answer is you don't. I don't, right? What we do is you pull capital together with other investors, and it's something called syndication. It's very simple. It sounds simpler than the actual word, and I want to explain exactly how it works. So again, it's a syndication is just a fancy word for group investing. And this is how it works, right? The sponsors, which is our team, like Phoenix Capital, we find the deals, we analyze hundreds of properties to find the right one. And then we secure financing. We will negotiate the purchase, oversee renovations, and then manage all the operations. And then eventually we're going to sell the property. And that's what we do full time, right? You as the investor, right? That is exactly what we are. So we are the operators, we're the sponsors, and you are the investors. You and other professionals provide the capital that's needed to make the purchase. So you become, a passive equity owner in the property. You're going to get regular distributions, you're going to get updates, but you're not involved in the day-to-day operation. And so that's what it's syndication. It's us pulling together between the sponsors and the investors, and we're able to acquire large properties. Now, you might be asking, well, how does the money flow, right? I want to break down exactly how it flows, because I want it to be very concrete for you to be able to understand this. So let's just say we're buying a $40 million property, right? And let's say we need about 12 million in equity. And that will be the down payment. So instead of one person bringing the full 12 million, let's say we had 120 investors that are pulling together 100,000 each. Now it's accessible, right? It's like, okay, I don't have 12 million, but I have 100,000, right? So that's the first step. And then we secure the loan for the remaining 28 million, and that's called leverage, right? And the more leverage you have, the more it like amplifies your returns. So now think about it, right? I want this to kind of be crystal clear. So the third step right now, every month, right, the tenant is going to start paying rent. And let's just say all the tenants together pay about $300,000 every month in total rental income. Then we take all of that, right? And so then we pay, all of the property expenses. So think maintenance, utilities, property management, insurance, everything. We pay all of that. And then we pay the mortgage, right? What's left over is profit. And that profit then gets distributed amongst all the investors, but it's distributed based on your ownership percentage. So just depending on how much you brought into the deal is going to depend on how much distribution you get from that profit. And then after that, over the next 5 to 7 years, we'll plan to sell the property. So all of that appreciation plus all the accumulated value is going to get distributed to all the investors, but it's going to just get distributed proportionally. So you can see your exact projected returns, and you can see and understand that in the investment summary. And then you're going to be getting monthly updates. You're going to actually be seeing how the property is performing versus just thinking about projections, because you're getting, like I said, monthly reports. So again, I want to be very clear about what your involvement actually looks like, right? Because this is what makes syndication perfect for busy professionals. You're not going to talk to a tenant. You're not going to call a repairman because an air conditioner is broken. You're not going to have to evict someone. You're not going to negotiate with a contractor. You're not going to evaluate a bunch of bids, right? You're not going to deal with property management. That's our job, right? Your role is simple. You review the investment opportunity that we send you. You decide if it meets your investment criteria, and if it's yes, right? You're going to sign the legal documents, you're going to wire the funds, and then you're going to wait as the property starts functioning, right? And so every quarter you're going to get distributions. You're going to get it, maybe a check or an ACH direct deposit, and then you're going to get performance updates monthly. And then every year you're going to receive your tax documents. So that's a K1. And then anywhere around year 5 to 7, right? You're going to, after we sell, you're going to get your principal back plus profits that you've made from the sale. That's it. That's the entire extent of your involvement. And that's what makes it truly passive. And that's why a lot of busy professionals are looking for opportunities just like this. Okay, so real quickly, I want to talk about the legal structure because I think it's important. And I'm only going to spend a minute talking about that because I know a lot of you are wondering, how does this actually get documented? Simple. When we buy a property, we create an LLC, so a limited liability company, and that LLC is going to own the property. And so then when you invest, you become a member of that LLC. And so your ownership percentage is going to be documented in the operating agreement, and you have access to all of that. You're going to get access to all of that in our secure portal. But that operating agreement is going to spell out everything, how the entire operation works. So how distributions are made, how decisions are handled, how the property gets sold, everything is in the operating agreement. So when you get it, right, take the time to read it, to understand exactly what you're investing in. And then at tax time, I talked about this, you're going to receive that K1. And if you've ever been maybe a partner in a business or invested in some sort of fund, right, you're probably familiar with the K1s, but it's going to report the share of your income, your deductions, your depreciation, your credits, all of it. Just hand that to your accountant and they will be able to incorporate that into your tax return. This whole thing is regulated by the SEC, so that's the Securities and Exchange Commission, and that just means that there are investor protections that are in place, right? So this is not fly-by-the-night deal, something that we create, but it's structured investments and it has real legal framework. So that's just a quick tidbit on the legal aspect of it, but I want you to know so that you understand that you are protected as an investor. And so And so this is kind of the old belief that I want you to think about, right? And that is something as like before you used to think, well, I need to buy property directly. Like I need to be the person that puts down all the cash to buy it and then manage it. But now understand that you can passively invest in real estate and you can buy large apartment complexes and you can do that through syndications. So this brings me to the third and final secret. How do you actually choose the right deals to invest in? Like which ones should you pass? Which ones should you say yes to? Because once you understand, the vehicle, which is multifamily apartment syndication, right? The next question is, well, how do I know if a deal is good? Like, how do I know? What should I look for that makes a deal a good deal that I should say yes, tick the boxes and wire the money? And I'll tell you this, right? And we're going to go over that in detail. But for me personally, my background as a physician has helped me because in medicine, we are trained in, evidence-based decision making. So we don't guess, right? We use data, we use research, we use a ton of proven methodologies to make decisions. And so I brought that same approach into real estate, and I want to share that with you. But let me tell you how most people make investment decisions, right? They might meet someone at a conference and they really like the person. The person seems like, most people seem trustworthy, right? They tell you the projected returns, they sound really good. And you're like, well, if they're getting it, so can I, right? Or maybe even a close friend vouches for them, right? And then you just say, you know what I'm in. But that's not investing. I see that as hoping. When I was looking at that first investment, right, I almost made that same mistake because I was like, well, the sponsorship group, they seem knowledgeable, the returns look decent, and I was ready to invest. But then I kind of started thinking about my training and I said, where's the evidence? Where's the data? How do I verify this, right? And that's when I created almost like a systematic approach to take away the guesswork. I want you to approach this with as more like informed decision and calculated risk when you're making these decisions. So this is a framework that I use to evaluate every single deal. And I want to walk you through it, each component, because by the end, I want you to know the exact questions that you should ask. So I'll go through this quickly. There are 4 areas that you should evaluate. The market. The market's very important. The property. I want you to think about the deal structure and then think about the team. So those 4 things: the market, the property, the deal structure, and the team. If you miss any of these, right, you're taking unnecessary risk, and I don't want that for you. But if you get all of this 4 right, you will drastically, you will dramatically increase your chance of success, and that's what I want for you. So again, it's not speculation, right? I want you to think about when you use this framework and you ask the right questions, right? It turns into evidence-based investing, and you're more likely to win. So let's start with the market. Because you can have the best property in the world, but if it's in a declining, if it's in a bad market, then you're just going to be fighting an uphill battle. And you can easily avoid that. So when you think about the market, right, I want you to think and I want you to see population growth. So I want to see people moving into the area. You don't want to see people moving away from it. You want to see job growth. So you want to see businesses that are expanding. You want to see companies that are moving to the area that you're buying, that you're investing in, right? You want employment diversity, which just means that you don't want the entire city or the entire submarket to be based on one industry type. Because if that major employer leaves, right, the whole economy in that submarket is going to collapse. So you don't want that. You also want to look for wage growth. So like as people earn more, right, they can afford to pay more in rent. You want to also look at like how are the rent trends, are they growing? Have the rents been increasing every year? That's what you want to see. And the one thing I also want to see is like, I want to be in landlord friendly states that have reasonable regulations. That's also important. So those are the things that you have to be thinking about when you're thinking about the market. For example, right, we invest heavily in the Southeast. So think Georgia, the Carolinas, Tennessee. And you might be wondering, like, okay, why? Why did you pick the Southeast? But it's because, just based on market research, right, people are moving there in like droves. Jobs and business are also moving there. And the cost of living is very reasonable. And kind of that business environment is feasible, right? And if you look at the demographic trends, it's undeniable. You can see it. Like if you look at census data, if you look at employment reports, if you look at migratory patterns, right? All of this is public information. Again, I want you to take off the guesswork. So that's what you should be looking at when you're thinking about population. So next is a property, right? This is where maybe we get a little granular. So we hire, professional inspectors, so like, contractors, roofers, plumbing, HVAC, all of that, because we want to know for the property that we're about to acquire, we want to know like what's the physical condition. We want to know when was the last time like there was major capital expenses that was put into the property, right? If the roof is 25 years old or 30 years old, then probably during the lifetime of when we acquire the property, if we end up getting it, we're going to need a new roof. So we need to budget for that, right? So we also kind of like when you start thinking about the property, right? We look at occupancy history. So has the property historically been 95% occupied, or has it been 70% occupied? Why, right? You need to be asking these questions, or at least thinking about it. And if you're thinking about it, then you can ask your sponsorship team, and so that they can give you a better understanding. You should also look at what the tenants are saying in reviews. So like Google reviews. We also pull rent comps, and so just rent comparables, right? So what are similar properties in the area? What are they charging? What are they getting for it? What are they getting in rent, right? This tells you kind of the upside potential. Like, can you increase rent? See what the area is going for. And then another thing to look at for the property is like something called deferred maintenance. So look at all the things that prior owner didn't fix, something that they put off. So they deferred it, right? Maybe they didn't renovate units in the last 10 years, right? Now, that's not necessarily bad, because that's opportunity for us, because we want to be able to go in and add value by doing renovations, but we need to know about it so that we can budget for it, so that as we're going in, we're making the right assumptions. And then also look at the unit mix on the property. So like, are there a lot of 1 bedrooms, 2 bedrooms, 3 bedrooms? Like, is this going to be more family? What type of tenant demographic is renting? Like, and also think about like, what is the market in that area demanding? Like if there's schools around, if it's more family oriented, so maybe the 2 and the 3 bedrooms are more likely to sell, right? So, and this will also affect kind of everything from rental pricing to like the quality of tenants you have. So you have to be thinking in order to ask those questions, so that you know that you are knowledgeable about whether or not to invest. And the point of all of this is that we are not investing, we are not buying blindly. We have the right tools, market analysis, that's given us objective data, so that we can go in and make the right decision. So next, the third area is the deal structure. So we're going to get into numbers just a little bit, so stay with me. But I want you to understand the questions so that you can ask them, because this is where a lot of people get misled with like shiny projections, and I don't want that for you. So you should know, of course, you should know what the purchase price is, but more importantly, how does it compare with recent sale of similar properties in the area? So the reason why you're asking is like, are you paying fair value or are you overpaying? All of that is important. And then think about like, what's the debt structure? Is it fixed? Is it a fixed rate loan, or is it variable? The fixed rate, it's going to protect you from like any interest rate spikes. Think about what happened in the last like 5 years. Variable loans are a lot more risky. So again, these are questions that you need to ask so that you can be empowered. But then also ask about like, what are the returns? Are the returns really conservative? Are they kind of medium? Are they aggressive, right? If someone's projecting 25, 30% annual returns, I'm just going to tell you that is a red flag. But if they're projecting somewhere around like 15 to 18, and they have clear assumptions on how they're going to get that, I would say that that's more realistic. So you want to see kind of, another thing is like a sensitivity analysis. So that what that means is that like, what happens if like occupancy drops to like 75%, right? What happens if like renovation costs are higher? Let's say you budgeted for 12,000 and they're more like 15,000 per unit, right? What happens if the sale takes longer? Like all of those things, you should be able to analyze for that. You should be able to make assumptions for that and be able to project based on that. And then another thing is like, when you start thinking about the deal itself, like what's the hold? Typically 5 to 7 years. and then ask about the fees. So, the sponsor, it's their job. So they're going to charge fees. So they'll charge fees for finding the deal, for managing the deal, and they'll charge a fee at sale, right? And that's normal because, again, you're working full time on this, but the fees should be reasonable. It should be transparent. If you ask, I should be able to, I should be able to tell you what they are. And then it's also important to ask about the exit strategy. So how are you getting your money back, your hard-earned money as a busy professional, right? So is it going to be, are we refinancing? Are we selling to another investor? Is it going to be sold to a REIT? Just before you invest, right, ask the questions and make sure that you are okay with the answers that you get. And finally, and I actually think probably this is the most important, is the team. Because this is the truth, right? You're not just investing in that property, you're investing in the people that are going to execute the strategy that they said they were going to, and you liked it, right? So figure out, ask them what their track record is, right? How many deals have they completed? How many deals have they seen through a full cycle market? Ask them those questions. Like, can they show you historical performance, not just projections, but for results? Like, investors should be able to ask that. We should be able to show them that information. You should also ask them, like, have they invested their own money? This is so huge, because if the sponsors have skin in the game, right, then their interests are aligned with yours. And if they're not investing their own capital, I think that's a red flag. You should be empowered to ask that question. Ask about references, right? Talk to other investors who've worked with the people that you want to partner with. What was their experience? Did they receive distributions on time? What was communication like? Were there any surprises? Like, all of that, right? I think that's all. I know those are important questions that you need to ask. You should even ask, like, in the market that they're going to, what is experience, right? Have they always been investing in one area and then all of a sudden they're buying in another area? You should maybe just pause and ask why, and see what the experience is. And I think for me, communication is very important. Do they communicate transparently? Do you get regular updates? Not just when things are good, but like even when challenges arise, right? Even when things don't go according to plan, because inevitably, right, we're making assumptions. Some of these are not going to go according to plan. Do you hear from your sponsors when this happens, right? Do they explain like their decision-making processes? If they had to fire the property management team, do they let you know that? Did they tell you why? Ask those questions, or at least you should be able to see that in communication. Because trust is built through transparency, and especially when, again, you're investing your hard-earned income, I think that's so important. And those are the things that you should be thinking about when you're thinking about who the sponsor should be. So before we move on, right, I would just want to give you some quick red flags that should make you walk away from a deal. Like, if someone guarantees you returns, if they say you are guaranteed to get this, you should run. Because real estate, if the market fluctuates, right, and honest sponsors will give you they'll give you projections, and they'll tell you, like we talked about, like these sensitivity analysis, but they are not going to guarantee you anything. If you feel pressure to invest without thorough due diligence, just run. Because solid sponsors, they want educated investors, and they want investors who understand what they're getting into, because those are investors who will stay for the long term. Those are investors who will become repeat investors when they're educated properly in the first place and they're not forced to do it. If there is lack of transparency, like if you ask for financials and you don't see them, if you want to visit the property and they don't let you, if you ask for references and you don't get them, you should run. Another thing is, like, look at their track record, or look at who they're partnering with, right? They should, if you ask for prior performances on deals, they should provide that. If you ask how they plan to execute it or what they've done in the past, they should be able to tell you that. If the projections are just like really good, right? If somebody tells you, like, invest with us and in 3 years, we're going to triple your money, that's probably, in the market that we're in, that probably won't happen. So pause and maybe run, right? And then if they're not managing, if they're not using property management, for like inspections, for appraisals, or just like using property management in general, and thinking that they could manage it on their own, especially with the larger properties, you should just pause, because again, you also want checks and balances in these properties that we're acquiring. So at the end of the day, I would say trust your gut. If something feels off, then it probably is. But these are the things that have helped me in the past, especially when I was a brand new investor. So that belief again that we're trying to change, right? It's that real estate is very risky, but I would say that if you go in with proper due diligence, right? If you go in with asking the right questions, if you have, if you start getting objective data, so looking at market trends, looking at property conditions, looking at financial structure, looking at the team record, their track records, right? If you have all of that, then you can go in and make calculated decisions and it doesn't feel as scary. Okay, so let's bring it together. I want you to kind of understand what we've gone through. So secret number one, which is that first secret, that multifamily real estate, it provides those 4 simultaneous ways to build wealth. So I want you to think about, cash flow, appreciation, loan pay down, tax benefits. Those are why it becomes a really wonderful vehicle for busy professionals who want to invest, who want passive income. And that secret number 2 is that, like, through syndication, right, you can passively own large institutional grade quality assets where you don't have to be the landlord, but you are pulling your capital together with other investors, while the professionals manage and they handle all the operations. And then that third secret, that proper due diligence. Think about the things we talked about: the market, the property, the deal, and the team. When with all of that proper due diligence, right, you can go in and you can invest with confidence. Now, I want to show you I talked you through understanding the importance of investing and then becoming a passive investor while still being a busy professional. I want to show you how these 3 secrets come together in a real life opportunity, because theory is great, but you need to see how it works in practice. So I want to introduce to you the Park at Arlington. So the Park at Arlington is our newest investment opportunity. It's 188 units, and it's in Covington, Georgia, and we're purchasing it for $33 million. So over the next few slides, I'm going to walk you through exactly how we applied these 3 secrets to the specific deal. So you're going to see market analysis, you'll see property evaluation, you'll understand kind of the financial structure and why this is a great opportunity. But more than that, you'll have access to kind of review the operating agreement, to review the subscription documents. You have access to the deck. You have all of that. And so you'll be able to really see the assumptions we made. You'll also get access to the financials, but you'll be able to understand kind of the assumptions we made, our value add strategies, so how we plan to force appreciate the value, all of that, you have access to it. So for those of you who are kind of here and you're ready to jump in, you want to commit to the investment, right? Our team is going to put up a link to our secure investment portal. And this is, at this point, this is non-committal, but go in, create an account, fill out the investment, and then someone from our team will be able to contact you. And you will get access to kind of all of those things I talked about. So, the operating agreement, which we went over, the subscription documents, the financial structure, the deal deck that has all the information, all the assumptions. You will get access to all of that. Okay, so I want to give you specifics about this investment opportunity. Number one, it's in a really strong submarket that's benefiting from Atlanta's continued growth and its expansion kind of eastward. So you're benefiting from that. Covington has great job growth, population growth, and it actually has limited new supply. And that's exactly what we're looking for in submarkets. That's kind of what I talked to you about in one of the secrets. But also another beautiful thing is that we're assuming a loan at 3.5%, and that is fixed. I want you to try to get fresh debt today, and it's probably going to be closer to more like 6, 7, depending on whether it's commercial or residential. But that's what that looks like. And today we're going to be assuming a loan of 3.5%. So we're pretty excited about that. So when I think about this investment, right, these are the things that get me excited. And that's some of the things that we talked about today. First of all, the property itself is not distressed. It's not falling apart. It's 94% occupied right now, and people want to live there, right? The fundamentals are already working, and the goal is to go in and to improve what's already working. And that part of that is through value add, through renovation. Now, when you do that, like that, our first plan, and you layer into the market, which is Covington, right? Rivian EV plant, they are building a massive plant right there in Covington, Georgia. And then Facebook's data center is already operational in that area. That is billions of dollars in investments that are creating thousands of jobs. And that translates to, people moving, that translates to jobs, again, growing, and people needing a place to live. So that's growth, all of that locked in to one place, one area, and we are benefiting from that as investors. And so now this is kind of why we love the deal, right? We are buying an asset that is already working in a market that is ready to explode within the next 12 to 24 months. And then there's a clear value add plan that is already proven. The old sellers have been doing it. The current sellers have been doing it. And so we're going to go take that over and continue that and renovate units to be able to force appreciate by increasing rent. And then we're doing all of that with financing that is better than anything that's available in today's market. So that's how kind of why this deal becomes a good deal. And these are the questions that you should be asking, you should be thinking about as you're thinking about investing. So this is what you earn, right? So you're going to be getting cash flow from about 6 to 10% every year, and that's going to be paid quarterly. So that's real money in your bank account. We don't do checks, we do ACH transfer, but you will be getting the money regardless. And then tax benefits, this is something I talked to you about, but around 45% in deductions per $100,000 invested. Now, I want to say this and I want to be clear, this is dependent on your investment and it will vary from it'll vary for each investor. And so this is something that you're going to chat with your accountant after you receive your K1. And then appreciation, right? As we start to execute our renovations, our business plan, and then as the jobs start arriving, like as the market starts growing, a conservative estimate is that the value is going to appreciate by anywhere from like 15 to 20%. And that is conservatively, but that's over a 5 to 7 year hold. And then in terms of returns, right, we are projecting around 15 to 17%, average annual return, but that's based on all the assumptions that we're making, kind of all the things that I've talked to you about. So that is our renovation plan, and then even managing, operating it better. So we have acquired and invested in about 120 million in assets across 560 units. And we have executed this value add strategy successfully on multiple properties. So what we plan to do at the park at Arlington, we know what works and we know how to really, the goal is preservation of capital. So protect your capital while still pursuing those returns. And I would say this, our approach is very conservative. And that conservative, like it appears in our underwriting, this is something that we do, is that we assume that things will go wrong because they always do, but plan accordingly. So I don't want to always show you like best case scenario, best case projections where everything works perfectly. I want to show you the goal is always to think through realistic scenarios and then have built-in buffers. I think that's the most important because inevitably, when we are buying a property, right, things will go wrong. And then another thing that we do really well is kind of thinking through like operational discipline, and that's through like our property management partners, also through tight financial controls, and always just thinking about like how can we being proactive. So how can we catch problems before they become really expensive? So we try not to wait on disasters. We monitor, we adjust, and then we optimize continuously. Now, I would say this, right? As you think about, again, who to partner with, the most important thing is to operate with an investor first mindset. So one of the things that we pride ourselves at Phoenix is that your capital is treated exactly like our own. And because in many cases it is, right? We as our ownership team, we invest in every single deal that we sponsor. So if I'm asking you to put money into the property, know that I'm putting my own capital alongside yours. And that's very important. You get full transparency. So regular updates, direct communications. And then if you have any questions, you can always reach out to a member of the team and we'll get back to you very quickly. There'll be no surprises. I will tell you this, right? I built Phoenix Capital as a physician investor, and I wanted to create the kind of investment opportunities that I wish that I had access to when I first started. And so I understand the value of your capital, especially as a busy professional, because I've worked hard to earn mine. And so I understand how important it is. And that's why, my big commitment is to protecting it, it's to growing it, and then it's to helping you build generational wealth through real estate ownership. Because I started this conversation saying it's one thing to be, to work 9 to 5, to love what you do. But then when you start thinking about real wealth, right, it starts with ownership. And so I would say this, right? If everything that we've talked about, kind of thinking through investing, if this aligns with your wealth building goals, then here are the next steps, right? Again, my team is going to put the link on the screen. Click on the link. It'll take you to the secure portal, create an account, and then start the investment process. Take your time, review the investment summary. You'll have all the financial details, the full transformation plan. So what we plan to do with the value add strategy, the return projections, kind of all the risk assessment. You have access to all of that so that you'll be able to make an informed decision. And then if it looks like it fits, next step would be schedule a one-on-one conversation with me, someone else on our team. And the goal of that is really to discuss your specific situation, your timeline, your wealth building goals. When is the right time for you? How do you want to include this in your diversification portfolio? And then figure out whether this investment makes sense for you. And then third, right, if all of that aligns, then we'll move forward with capital commitment and then getting you officially invested as an owner of the park at Arlington. And then, so this is kind of what the investment process looks like. We're planning to close end of January, and then between Q2, Q3, we're going to start renovations after we stabilize the acquisition, and that takes a few months. And then we will continue that plan over the next 2 to 3 years, and then plan to exit at year 5. And this is a question I get asked a lot, and I just want to mention it here real quick. You can either invest with cash, and that's very okay. You have access to how to do that on the portal, but you can also use an old 401k or use an IRA. And the process is pretty seamless. We have a custodian that we partner with who will walk you through all the steps and kind of take you through the whole process. But you're basically taking your old 401k, not your active one, or an IRA, and you're going to convert that into a self-directed IRA. And then you can invest in alternative assets just like this with that. What the reason why I'm telling you this is that you have options, and I want to make sure that you're aware of it so that you can make, again, the best informed decision. So as we wrap up, I want to leave you with one final thought. You have worked, as a busy professional, you've worked incredibly hard to build your income. That looks like years of education, long hours, and even sacrifice, right? You've climbed this mountain of professional success. But I would tell you this, at least I want you to pause and think about this, right? Income and wealth are not the same thing. Income is what you earn, and wealth is what you own. And so you've built this income, and so now it's time to build the wealth, right? And the beautiful thing is that you don't have to choose between one or the other, right? You can keep excelling in your career while you're simultaneously building a portfolio of income producing assets that's helping you now create financial freedom, at least get you on that path. So I would say this, right? If you're thinking when, the question isn't if you'll invest in real estate, right? The question is, when will you do it? And I want you to think about the best time to do this was 10 years ago, and the next best time is now. And so the knowledge you've learned, the opportunity in front of you, and our team's on standby, right? It feels like all the pieces are in place. And so I would ask you to kind of just sit back and figure out the right decision that you need to make so that you can take the next best step. And if you are thinking, if you're like, okay, I'm not sure, go ahead and click the link to the portal, schedule a call, and then we can walk through all the various options that you have. So I want to say thank you for your time. And I look forward to connecting and to speaking with you soon. So if you have any questions, please feel free to put it in the chat, and I'd love to jump in and answer any questions. Okay. Maybe I was very clear and there are no questions, but I want to thank you for your time today. And again, feel free to reach out if you have any questions. We'd love to connect and kind of walk you through the process. Have a great evening.